What's going on, traders? And welcome to another live. Um, we're going to switch up a bit this week. Usually, I obviously do my missed trades from the previous week. And while that's been great, and I think a lot of value has been provided through, I think, being aware of those setups that I'm missing and those setups that I'm not capitalizing on. This week, I wanted to do something a bit different. I've reached the end of my first set of trades, my first 20 set. And so I'm still trading for the rest of this week, but heading into the weekend, I'm going to be flipping into review or sort of more of a reflective sort of state as I look over how this first 20 trades, how these first 20 trades have performed, what the biggest tweaks or takeaways are from them, what some of my recurring mistakes are. I'm going to go deep into it and just keen for then obviously the review that I post this coming weekend, which is going to be a monthly review, but then also obviously a set review, which will then provide you guys with my revised plan for the next 20 set. And we'll go into a bit more detail on goals and capital and how I'm scaling. So the quarterly, the Q4 video that I promised you guys, that's coming up basically this weekend. It's been a busy week, busy week. 6 trades taken so far, practically break even, but in if we're being technical, down 0.15%. So check the link out in my description, which will take you to my trading view profile where I do all my trade recaps, forecasting. So you'll get a detailed look at how I've been forecasting positions, how I've been executing positions, how I've been managing positions. I think that's going to give those of you who are looking to level up in that area a lot of value. And so diving into this week's topic or focus, I basically looked at month 3 of the ICT mentorship and extracted from that, from each lesson, there's 8 lessons, what I feel like the biggest takeaway, or where I think a lot of the value can be unlocked for this next set going forward. And so in this session, I just want to dive into that a bit more, dial into it, and see how I can potentially incorporate this into my plan next week. And this is arguably going to be broken up into 2 sections. So I'm still going to think about how to do this in terms of still being able to update and revise the plan this week, but then potentially I think I'd have to do another backtesting session before I then obviously update the plan, because while this looks at institutional order flow, which focuses a lot on the high time frames, defining your monthly ranges, and then looking how that obviously plays out on the weekly to refine that, and then on the daily, which refines it even further. The institutional sponsorship more so looks at signs in the market that there is that institutional presence and there are levels that are being protected by means of displacement and recapitalization. And, there's some high value nuggets in there that I think will contribute quite a lot going into my next plan. And so that's going to be a separate video on its own. I think this is going to be more high time frame. Then that looks at more so the daily and the daily 4 hour, 1 hour. And it's got a specific focus on time as well, which is quite cool. So from the 8 lessons, these were the 2 that really focused on institutional order flow, that being the actual institutional order flow video. And what it's basically about is that the wicks on the monthly or weekly candle, contain a large amount of volume, which institutional entities use to fill orders. And banks need, billion-dollar orders as counterparties. And so these levels, the weekly, monthly timeframes, that's where these orders are most visible on, right? So it's just going back to that age-old principle that we all know, but don't probably implement as much as we should, of, using the high time frame to build the narrative, using that top-down approach in a sense. And so the question I'm really asking is, where does the market react from looking at the wicks on the monthly down to these levels defined on the weekly, down to these levels defined on the daily time frame? This should be to the daily time frame, right? And then a couple of lessons later, ICT revisits this concept, and he's basically talking about anticipatory skill development. And what he's looking at is basically how he defines bullish and bearish trends using institutional order flow. And so basically in a bullish trend, right, and you really on a monthly candle are using a select number of time frames. And we'll go through all of this in the charts in a bit, but your range low in a bullish time frame is essentially the most recent bearish candle open or high, right? That's your low, because technically once price trades above that, you have an order block. And so you are then bullish from that range low higher. Then your range high is then defined as the most recent bullish candle open, or low above the range low high. Sounds confusing. We'll get to it in a bit. On the inverse, your range high is the most recent. This is in a bearish trend now. Your range high is the most recent bullish candle open or low, right? Because technically in a bearish trend, once you trade below, a bullish candlestick, it's an order block, and that now defines your range or where you're looking to go short from. Then your range low is the most recent bearish candle open or high below a range high low, which is essentially a bullish order block. And then the question that came out of that was, how does institutional order flow help forecast longer term price movements by the ranges defined on the monthly down to these levels refined on the weekly, down to these levels refined. Why do I keep saying monthly? The daily time frame. And so what the back testing is going to be a combination of both of these, where I'm going to look at the monthly first and identify these ranges, right? And then and it's going to be more of an observation than a position back testing. I think this is more of like a study session than a testing session, because I'm trying to determine proof of concept and how to apply these concepts in a way that aligns with my plan. And so what I'll be looking at is Euro USD from March 2015 right up to Euro USD March 2023. And that's mainly because we just start to range after that, and there's not much moves there anyway. And so starting in this level, obviously displacing down aggressively, had this displacement, clear imbalance, and then somewhere along the line we form a low. What I'm conscious of is that, or just what I'm observing, and to be honest, this is maybe going to be more of a work session where I'm back testing, and then I will recap you guys. I'll give a recap of maybe what I've plotted out instead of a more active talking session. So feel free to plot questions in the comments if anyone jumps on. It's not on at the moment, but yeah, let's get into it. Okay, so what I've basically marked out here that you can see is firstly just wanting to identify the area that price ultimately retraced from. We came down, or yeah, hence I extended this fair value gap from here. We, I think, just missed the base of that, but that's fine. I think there was an area of uh, liquidity here that recapitalized, that was recapitalized, and so when we eventually came very close to it, we got that institutional sponsorship to the upside, which then eventually broke this fair value gap. But obviously, on the initial entry into the area, we stalled a bit. We came up higher. We then mitigated this fair value gap, shallow, mitigation. We respected the mean threshold area, which is just that midpoint of the fair value gap. So you can see didn't get close, and then price sold off. Where did we sell off to? Wicks on the monthly or weekly contain large amounts of volume which institutional entities use to fill orders. We came just below the body of these of this candle. We obviously then defining this as an order block, for lack of a better term. Recapitalized, came up again into the fair value gap, which held once more. So this fair value gap from March 2015 up until May 2016 for 2 years held this range and then was valid. So a clear area that institutions were using to as an area clearly where counterparties were just resting and they were just playing ping pong between this area and what the liquidity that was resting below here, because obviously we had to build up liquidity here to eventually sweep it below, which we did. And then so this held for the second time. We then come down, sweep this liquidity. Once we break above this body high, we form the order block, which you can see holds on the next candle. And I'll go down to the weekly and daily to see, what came first, the low or the high. And then, yeah, we displace to the upside in what eventually runs this fair value gap after 3 years. Because arguably, even in this second year, it held and we got a bit of a sell-off. So that was the first thing I did, which kind of explains just what is going on here. And obviously then in all of these moves, the first perhaps clear setup would have come at the break of the, maybe not the break there, but the rejection of this fair value gap. And then potentially coming to sweep this, the fair value gap below here would have been marked. So I would have maybe assumed that was targets. So we could have shorted from August for a couple of months, November, and then things shift. Recognize that this order block is holding. Once we break above this low here, technically that maybe I would have marked the range high. And this is why it's tricky as an observation, because there's levels I see could have been range high and lows, but there's nothing to define those ranges with, because you obviously need two levels. For example, once we break out of this bearish candle here, I'm looking to the left for the next bullish candle. It's all the way up here. Maybe at the time I would have thought that was possible, but obviously we would have had to clear a lot, and on a monthly time frame, it would have been hard to maybe accept that that was all going to happen in one move, especially after a very impulsive move. And so it was a while before we got a solid tight range that we could define, because arguably even the second move here, or even this third move, the second move rather, we get this bullish mitigation, and then we get this impulsive candle that closes below. At the time, I would have thought continuations are in, and so looking at defining the bearish range, that being our high, I need a bearish candle below this that can define a range. None of these here qualify. So it would have been this candle here. The high or body or wick, whatever is relevant. Because that's where I think an element of discretion comes in. Arguably, we almost reached it, but if our bias was short that entire time, we would have missed out on, all of these multiple moves here. So couldn't really put it there. We obviously then got into that wick area and rejected from, obviously, we recapitalized that area and traded higher for a second time into the fair value gap. Once we then broke lower here and engulfed this previous doji, if you want to call it that, we then established this range high, which we could then define with this range low. And if we go back to our definition, what in a bearish trend, how do we define that range? Our high, most recent bullish candle open or low. After a close, most recent bullish candle open or close. I've used the open in this sense. And we are essentially bearish anywhere from that point. So even though we closed below here, you see we got the pullback up into that area where we then were sellers from. Range low, most recent bearish candle open or high below range high low. Most recent bearish candle open or high below range high low, right? This is the range high low. So we're looking for the most recent bearish candle below that. And I'm using the body in this sense to then extend it across. You'll see there was a time where I was arguing, could it have been a wick? Because then it would have been a cleaner fill, would have got there in 2 months. Because if we used the body, then arguably there was like a bit of a near miss, and then we corrected a bit, and this could have been long opportunities the entire time. And then we eventually do fill it. But I'll filter down into the low time frames and see maybe what was going on there at the time. And then this move eventually sweeps to the downside. And once we've obviously extended beyond a range low or the defined range, if there is a relevant candle below that makes sense to plot an additional area within that range, then I can use that. But in this case, there wasn't. So I can then zoom back out into what's going on from the perspective of, okay, now we've swept this liquidity. What happens next? Okay, now we've impulsed higher. Could this be my range low? Define my range low. It's also an order block. Range high. Let's go back to our definition. In a bullish trend, our range low is the most recent bearish candle open or high. Bullish trend, range low is our most recent bearish candle open or high. The high wouldn't have made sense, so we use the low. Our range high is the most recent bullish candle open or low above the range low high. So where is our range low high? It's this point here. Our most recent bullish candle open or low above that point is this candle here. And we can see we fill that. Could have used the wick or the open for this. And so then we fill it, and we eventually come into the fair value gap, violate this mean threshold. Look, 2 months, we get a pullback, but we, and this is one thing I'm starting to hear now, realizing more is when we form fair value gaps as we displace towards an area that should act as a point of reversal, then that should be a sign that we are perhaps not going to reverse. And so even with this, we can see that we came into this fair value gap. The first sign would have been the violation of this mean threshold, because what I'm also noticing is once we get so deep into a order block or fair value gap, the odds of it being violated are very high. At this point, I would argue that it may even just serve as inducement, because we literally don't break it to the pip and we start to trade lower. Even those trading this strategy will start to think, oh, this level's holding. Okay, we in, sells are in, let's go. You get 2 months of bearish behavior, and then we're actually just coming into a fair value gap, resting below, and then we displace to the upside. So just from this pocket of price alone, which is 2 years on the monthly, I think there's a lot that's happened there, and it's not all so clear on the monthly, which is why I'm going to go down into the weekly now, and you may see some of these levels refined a bit. You may see some being added. There may be some that I can add to this area here now where there were no range highs or lows, because those that only started to get clear after the second mitigation of the fair value gap. There may be more reasoning or more of an explanation as to why we turn from this point. What happened on the weekly? What happened then on the daily? Why did what were the signs that led to this reversal here? What were the signs that led to this reversal here? This reversal here? This one was relatively clear. We swept liquidity, fair value gap resting below, and then broke higher, but there could have been something there that was telling us that we were about to sweep. So as clear as this is on the monthly, and already I think it could give us a good foundation for what's to come, it just gets more and more granular as you come down to the weekly and daily. And arguably, once you have really honed these high time frames, the 1 minute is probably 4K if your monthly is 1080p or 720 or whatever. So I'm going to jump down into the weekly time frame, take some time to analyze what's going on, and then discuss it with you guys in a bit. Okay, that was a bit intense on the weekly. You're gonna have to bear with me because it gets a bit messy, but I'll go through it briefly because time isn't great. But follow me. I promise we're almost done. If you want to pause now, get up, stretch your legs, get some water, get some fresh air. Do that now because I don't want this to go over your head. So pause now, take a break or breather. Okay, I assume you're back. So what we had on that initial descent, the first time we peaked above this, what then became an order block, which stood the test of time, was a correction into a fair value gap, which was respected. We then sold off from the fair value gap into the order block quite aggressively, quite deeply, violated that mean threshold, but we still held. So there was arguably position short from this fair value gap down into the order block. Could look refined on the daily. And then we displace higher, clearing this fair value gap. But that is more just, I think, the sponsorship of this level holding here and establishing that. And now we've displaced higher because then over the next couple of weeks, we get the slow correction. And this time we get a much more shallow mitigation of the order block. Arguably, we've got this secondary order block in here as well, which price respects. But we don't need to put that on because we mitigate our original order block in any sense. So the move is the same. Within there, we can see a sweep of liquidity, and then we displace higher, which is the first mitigation of this larger monthly fair value gap. Within there, we have a secondary fair value gap on the weekly, which gets mitigated. Looks like the mean threshold is respected. That's a wick, and we retreat straight away. We didn't spend a lot of time in there. So that's interesting to note. That was literally in the course of a week. And I guess that is the first real mitigation of a monthly level. And just something to note because it may indicate the amount of liquidity resting in these areas. And so knowing when price gets into these higher time frame fair value gaps or order blocks, then the market may not spend a lot of time there, at least on the initial entry. We then sell off. We could argue that there is this sweep of liquidity, right? Sweep of liquidity, but the order block still holds, right? We've got that hold, and then we eventually start to come up and trend. We form this order block then, which holds, and then we continue to the upside. Unclear, I would say, on the weekly as to why we swept this liquidity. I understand, obviously, why we reversed after sweeping there because there's liquidity resting above there. But obviously, there's this wick as well, which I would have thought played some sort of role in where price reversed from, and perhaps it does, but I think it might be clear on the daily to see. But in any event, we reversed from there, came lower, back into this order block, which was recapitalized slightly. We got a pullback. That pullback, look, we had an order block here, we had an order block here, but it's such a large area, I think it's clearer on the daily. But obviously pushing out of that area, we then formed an order block again, which once we got a third rejection from this order block, came up, mitigated. Yes, we violated the mean threshold, but then we displaced lower. And so in all of this, two order blocks that we've plotted, this primary one and then this minor secondary one. Primary one gave us one setup, two setup, three, 4, arguably 5, but this is now part of the new order block, which is 1. But now we're on 5 on this original one, and then 6. The new order block gave 3 entries. Because we remember this is weekly pullbacks. We're going to be trading those. It's not just a pullback that we'll observe to then trade in the direction of the trend. No, this is 1, 2, 3, 4, 5 weeks, a whole month of bullish price action setups. We're obviously trading within this range here, so we will find setups in there. But what I'm just trying to illustrate or highlight is that there, from one area, can be multiple setups. And while this looks like a range on a weekly or monthly, this range is providing a lot of opportunity. We then come up into this order block, we sell off aggressively. This is then the sweep of liquidity that just misses the monthly fair value gap. It was the low that came first, because remember I said I wanted to see on the weekly what came low at the formation of this range low, either the high or the low. It was the low. This was actually New Year's Day. As we traded above that, we formed an order block, which we then respected, broke higher, formed a secondary order block, which respected, opportunity to scale in or re-entries, and then we moved. And then I've just refined these fair value gaps here. And then in closing, what I finished off doing, and it was mainly for this beginning section before we started getting our defined monthly ranges. And I'll say it before I've explained it, but I arguably just prefer the monthly ranges, just because the weekly that maybe lead to a bit more aggression on the lower time frame. But what we can see is initially breaking above this high, recent bullish candle, that's our range high, we achieve that. We break back below this low, this is our range low, we achieve that. Break back above the high, range high, we achieve that. Break below the low, it's our range low, we achieve that. Break back above this high, this is our range high, this is our range low now, we achieve that. Break below this low, down to this range low, we achieve that too in a matter of weeks. We fall a bit lower, extend beyond these targets. First candle above this low, above this high, which now forms that order block. Our range high is all the way up here. It's not without a bit of correction, but we achieve it. But before we do that, we form another range that we can trade out of, breaking above this high here, targeting the same high, arguably scaling positions, and we achieve that high. Straight after coming off of that high, break below the low, back down to the range low, we come down there again. And so what I'm at least noting or picking up in this session is that the weekly ranges, at least in this tight range that I've just analyzed now, plays out quite nicely. But this is over like a week or two. These are much shorter time ranges, but could help in determining the distribution of the following weekly range. Right. And so, yes, this is very high time frame. Yes, it's looking at like things from a very zoomed out perspective. But as you get more granular, as you go from the monthly to the weekly and then eventually down to daily, you can see that you can start to build a picture of how this is going to inform your trading on a weekly basis, then potentially on a daily basis, if there's proof of concept there. And if you understand how to apply it in your own plan. And this is something I look forward to incorporating come this revision of the plan, because I think there's some major tweaks and takeaways that can come out of this. So remember, guys, consistency is a choice you make when you start doing the things you know you should be doing.